Hello and welcome to part 2. Now, in the last podcast, John went through 4 of the 7 things that actually apply pressure to really retirement. He talked about withdrawal rate, pension, Social Security, and longevity risk. Now, we're going to cover 3 more today. And if you did not hear the first section, please, I would actually just recommend you hit stop now, go back and listen to part 1 of this, and then come back to this. But if you did listen to part 1, this is where we're going to come to some sort of a conclusion on really what's to be done and other risks that you really need to pay attention to. So, John, once again, welcome to the show, and let's dive right in.
Great. Thank you. So the key in the financial plan is to understand what the current components of your plan are, right? What are the chess pieces? What do you have? Do you have a pension? Do you have Social Security? Do you have savings? Do you have a 401k plan? Do you have rental real estate? What's your plan? Okay. What's that secret mix that you have? Now to take a look at it and understand how is it positioned, and if you change nothing about it, where is it taking you? Is it reducing your current and future taxes? Is it reducing your current risk and future risk? Is it reducing the fees and costs in your plan? Is it increasing your savings rate? Is it increasing your retirement income potential? Is it giving you more benefits and more protection from eroding factors? And will it pass more to your family? That's what you got to understand.
Sure.
Right? So now to back that, to basically back up and sit here and say, let's assume for a moment that I have a retirement, and I hate to say this, a retirement income goal, goal of $10,000 per month.
Okay.
Because a goal is sort of goals are great, but they could also take you in a completely different place that you need to be and not really looking at the reality. Mm-hmm. You have a goal to start $1 billion a year organization out of my garage, right? Mm-hmm. I'm 50. Have I done that yet? No.
Well, I don't know. I haven't been to your garage yet, John. So, you might have something hiding in there, but continue.
Maybe if it is, I don't see it. So what's interesting is you have to look at this and say, what are those core components of the $10,000? How much of that monthly cost is going to be covered by things that are sustainable, guaranteed, that are here? Mm-hmm. Social Security, pensions, right? The sources of retirement income. How much of that is going to be covered by things that might happen or things that are more secure in happening? You have to think of it. Do I want a sure thing to cover those $10,000 a month, or do I want a maybe?
Oh, I don't want a maybe. Yeah, no, I definitely want to feel like there's as close to, guarantee is a word that we really try not to use, but that would be, I'd like as close to that as possible. How's that?
Right. And I think if you listen to the last podcast, you're going to realize that not a lot of things are guaranteed.
Right? You were very clear about that. Yeah. Except
for death and taxes, everybody always says, but taxes are not guaranteed either. Death is. I think death is the only thing that I can talk about that I know is going to happen. I don't know the time, date, and location, and whether or not somebody invents a pill that makes me live to 180, which will really mess up the sequence of my retirement.
Yeah, that'll totally change absolutely everything on the first podcast in this miniseries that we did when you talked about longevity risk. So
I listened a few years ago to Ray Kurzweil, and I'm trying to get to another event that he's going to be doing in September or October that I heard about. But he had talked about if you could keep your body at the current, health that it's in and the condition that it's in, that in 10 to 15 years, they'll be introducing, let's just call it nanobots. I don't know if that's the right term because it was a few years ago, that will keep you at the same age for another 20 or 30 years. Mm. And his comment was, you need to have a lot of money if you're going to do that. I was like, yeah. So in the retirement thing, getting to this $10,000 a month, well, how much of that is covered from Social Security? How much of that is covered from pensions? How much of that is covered from my portfolio? And what is the withdrawal rate in order to hit that? Okay, if it's greater than the 4%, we probably have a problem.
Right.
But it has to come down to everything is about strategy, and everything that you do is about strategy and how do I organize that chessboard in the proper methodology that's going to achieve the goals. reduce the taxes, reduce the fees, reduce the costs, reduce the risk, right? Increase the retirement income, increase the savings rates, increase the amount of wealth that you pass to your family, and protect more of it. Those are the goals, right? And most financial strategies do the exact opposite. And when you run them and you simulate them, you can visually see that, hey, this is compounding my taxes, which we've talked about. This is compounding my fees, which we've talked about, okay? And these are things that if you have strategies to reduce them, you should potentially, if you reduce your expenses, you should accumulate more wealth. All right? So what I want to talk about here is the three things that I want to hit, or four things that I want to hit, is the longevity risk, healthcare costs, long-term care costs, and market volatility.
Okay.
Okay. So when you start thinking about withdrawal rate, saying, the studies out now have been down to 2.5%, almost 3%, depending upon who you're reading it and what you're talking about, it comes to that withdrawal rate. And one of the key factors in withdrawal rate is market volatility. And we had a year where there wasn't a lot of volatility. Now we have a year where there seems to be a lot more volatility. Okay. And volatility is a consistent trend. And most financial planning softwares that I've seen do something called Monte Carlo simulation.
Yep.
Which is the preferred standard. And it basically takes all the possible, outcomes and puts it over a period of time and says, based on based on the way your money's allocated, we would expect you to get this rate of return over the time frame. Well, I'm just going to hypothetically say 6%. And then the financial planning software basically gives you a 6% return. The problem with that, it's 6% every single year. Right. So you're not getting – I've never seen a market curve that it's like an exponential flat, beautiful swooping curve, that it's smooth, right? It's bumpy. It's a bumpy ride. It has ups and it has downs. And as soon as you have ups and downs, you start to have a problem. I wrote a book a few years ago called 5 Ways Your Wealth is Under Attack. And one of those, we spent a lot of time highlighting this, withdrawal rate risk and the impact of it. And it's a very simplistic conversation. If you visualize this, most financial planning and most things are using an average rate of return. What's dangerous about average rates of return is most people do not get the average rates of return because this is kind of deep, but money is a commodity. It's not math, and it is subject to erosion principles. Okay. What do I mean by that? So let's assume we have, and this is an extreme example, and you can win dinner tonight if you bet your friends on this as you go through it. So we have a sequence of return. We have the first year, we have a number that's plus 100. The second year, we have a number that is minus 50. So now I want to find out the average rate of return. I take 100, subtract 50, divide by 2. That's 25. So what most people do in their spreadsheets is they go put in the 25%, and they say, I have $100,000. 2 years later, I should expect to have what in the plan? A 25% average rate of return. So the first year, 100 would go to 125. And then 125 would grow by 25%, which would bring you to around $156,000.
Okay.
That's what I'm expecting to see in my spreadsheet. I would expect what I would see in my account. And then reality sits in, right? If the money goes up 100% in the first year, it's really worth $200,000, right? 100 would go up 100, would be up 200, and then it falls by 50%. What are you back down to? $100,000.
Wow. Okay.
All right. So your actual experience is a 0% rate of return. Now that's annualized volatility. Right. Does volatility occur at the end of the year, on the quarter, on the month, or daily?
It's all over the place, right? Daily, yeah.
Correct.
It's not. Yeah, it's not a consistent trend, right? I see what you're going.
No. All right. So if I'm putting into my strategy a 3-4% withdrawal rate, and I'm simulating annualized returns with volatility, it might work. It might not work, and that's what Monte Carlo is trying to do. But the reality is, you and I are going to get our own sequence of returns. based upon what we've invested in and how we put money in and how we withdraw that money, when we withdraw that money. Mm-hmm. It's going to be different. If we had 20 people sitting at the table, there would be 20 different outcomes based upon those mixes. And when you start thinking about where we are in the economy, when you look at all these things that say 3.8% or 2.8% or 3% for the withdrawal rate, they're using historical performance.
Yes.
What do we know about historical performance?
It is not indicative of future results. Did I get that right?
Yeah, and it's not guaranteed, right?
It's also not guaranteed.
Past performance is no guarantee of future results. Yes. And we do have a disclaimer on the podcast that says that.
Yes, right? Absolutely.
And the reality is, past performance has nothing to do with what's going to happen in the future.
Nope.
But if you look at some of the economics that are out there, since I've been in the industry, interest rates have been falling in the economy. We've now hit a spot where we might have hit a bottom pattern and we might be trending up. If I own bonds to offset my risk or to generate income in my portfolio, as the interest rates rise, the value of bonds should do what? Fall.
Mm-hmm.
All right? It's like a seesaw. Visualize the kids out on the seesaw going up and down. The further they are, the bigger their swings are, right? So on the left side, picture the value of your bond, a dollar sign. And on the right side, picture a percentage sign.
Mm-hmm.
As the percentages go up, the value of the bond goes down. As the percentage goes down, the value of the bond goes up.
Mm-hmm.
So since 1981, when the 10-year Treasury was 15.81, and now it's 292, 295, as I'm looking over across the room at the screen, that's a big drop, right?
Yeah.
So as that's been going on, the value of bonds have been going up. So now are we on the other end of the spectrum, going from 2.95 up to 15? Who the heck knows, right?
Yeah.
But as I do that, it's going to put pressure, okay? Yes. So volatility, risk is volatility. Now, inside of risk, when we're talking about reducing risk in a financial strategy, risk is not just market risk. It's, there's a whole long list of tax law risk, geopolitical risk, state and local risk that you have as far as the pension plans in your community having a problem, your real estate taxes going up, your expenditures going up, inflation. These are all things that are beating down on the risk that's in your plan, and you need to identify how well is your plan prepared for these risks, okay? Now, let's talk about healthcare risk. The latest estimates, there was an article in the Motley Fool, December 2018, what will healthcare costs in retirement be? The latest estimates show that an average couple will pay more than $400,000 on healthcare costs that are not reimbursed.
In their lifetime or a year?
In retirement.
Oh, geez,
over the course of retirement. So here's a pressure. Knock on wood, I've not had a lot of personal health care costs, right? At the moment. I got my AARP card last month, and maybe I'm on the other side of that, right?
Mm-hmm. Maybe.
Highly probable. So and that does not include a long-term care event. It's like $220,000 per person. 250, depending on what study that you're reading. And that's non-reimbursed medical expenses and hearing aids and all the things that you start thinking about just coming out of your plan. And the article basically said, if you divide 400,000 by a 20-year life expectancy, 65 to 85, retired Americans will see costs on average $20,000 per year for healthcare. If 75% of the country has less than $50,000 per year in income, that's what this article is saying, how are they going to live?
Yeah.
All right. So healthcare costs are devastating for anybody, and with longevity risk comes increasing healthcare costs. Okay.
Mm-hmm. Well, I'm still with you, man.
Long-term care. Yeah. Average long-term care, they say, is what? What's the average stay in a long-term care cost in a long-term care facility for a person?
It's astronomical. I don't know what that number is.
Yeah. It's like 2.5 to 3 years. And it's 1 in 4 will end up in a nursing home. That's an additional cost on top of that. What kind of nursing home are you going to be in? Are you going to be in a skilled nursing facility? Are you in assisted care? And I've been in a lot of them because my father got sick over the last couple of years. And when we knew we had to put my father in a skilled nursing facility, we took the top 15 referrals in South Florida and we went and looked at them. The number one referral was the most depressing place that I ever went to and cost about 10 grand a month. We ended up in another place where skilled nursing was about 14,000 a month. Wow. So how long is your plan going to last with the average stay? Now, average, how do you get an average? Some people stay shorter, some people stay average, and some people stay longer. What's the outcome that you're going to get? No idea.
No idea.
No idea. Can't predict it. Don't even stay up at night worrying about it because you can't control the outcome. I've learned that. Okay. Mm-hmm. So what's my plan? What's my backup? What's the lifeboat, as we talked about in the earlier plan, to help defend against these costs if they come? If they don't come, what's my plan? Because in a perfect world, I don't wake up in a nursing home. I wake up in a funeral home. Right? Yeah. That's the perfect world. I spend my last dollar and I'm gone. Mm-hmm. And my kids inherit everything beyond that. Mm-hmm. Right? But the reality is, you start thinking about it. So I got withdrawal rate. I got longevity risk. That my money, I'm going to outlive my money. I've got a pension debacle in state and local governments and corporations. I've got Social Security in what I call an inflection point that's really dangerous with 2-to-1 ratio 13 years sooner than everybody predicted. You got healthcare costs booming out of control. You got long-term care booming out of control. You got market volatility that's just beating down on your wealth potential. None of this is new, by the way, right? This is not rocket science. This is not something that I just, oh my God, this is enlightening and this is new. But you need to talk about it. Mm-hmm. And we need to start really talking about is what's my plan in my financial strategy if markets go down 3 years in a row, which they have, and they most likely, I'm not going to say that, they could. Mm-hmm. And, market goes down, you have a bear market some people say every 6 years, every 7 years, who knows? But the question is what's going on in the time frame in which I need to take withdrawals in a down market.
Right.
So if I have to take withdrawals in the down market, the propensity or the likelihood of running out of money goes up exponentially. If I have a crisis in a down market and need to take out more money, now I've accelerated that, mm-hmm. which there's no control over the crisis. And I say liquidity crisis. The kids call up and they need $40,000. Oh, no. Can't not let the kids, right? Mm-hmm. And we see this all the time. So my point that I'm trying to say is how secure and how safe is your current retirement plan? How much of it is based on pretty good, pretty sure things versus maybes? What triggers are in your financial strategy that my father and I used to love to do this, and we would, this was our dinner table conversation. We'd work all day together, and then we'd, go home and we, as a kid, that's what we talk about. And then we'd work late, and this is what we talk about is, what if you change that variable? What happens? Well, wow, look, instead of having, what the projection said was going to be millions of dollars, now it's 50% of what you said. Now change that next variable. Make inflation 4% versus 2.5%. And the plan's done, right? Mm-hmm, mm-hmm. And this is you have to do this to have this is the world has led us to believe is that, it's a set it and forget it. Do this and you're going to be fine. Do this and you're going to be fine. Do that and you're going to be fine. I'm a better manager than you are. My product is better than your product. My simulation is better than your simulation. Right. And that's all crap. It's all crap. A good friend of mine gave me a shirt one time because I was saying crap too much, and he gave me a shirt that says life is crap because everything is crap. And I'm trying to control crap, but it's crappy. Okay? All these variables are subject to change, and nobody knows what they're going to be. The most successful way to build a plan is to say, what is going on right now? All these variables. How are my parents protected? How are my kids protected? How is my wealth protected from an insurance perspective? Property and casualty, umbrellas, long-term care. How's my life insurance? What are my wills set up with? Is my life insurance going to be here in retirement or not going to be here in retirement? And just to shoot on this, life and death is going to, if you make it to 65, death is going to occur after 65. If you make it to retirement, death is going to occur after retirement, right?
Yep.
I'm just kind of trying to be funny again, okay? But unsuccessfully. Thanks for laughing.
You're welcome.
But,
that's what I'm here for,
I know that. But death is going to happen. And what's going to happen upon my death in retirement? Well, if I have a pension, it may have a survivor benefit that gives my spouse 50%. My spouse is going to lose her Social Security and take mine, or keep hers and lose mine, whichever one is higher. She may incur medical expenses that she doesn't have now, like healthcare. A lot of retirees have healthcare paid, and then the spouse dies, they lose it. Do you know that variable? Do you know what the survivor? I can't tell you how many people come in and have no clue they're collecting a pension plan. They don't know what their survivor benefit is. Oh, I think it's 50%. I think it's 75%. What do you mean you don't know what it is? How can you go out to dinner tonight not knowing what that is?
I don't know.
Do you have an umbrella liability policy? So I'm old and I can't see well, and I'm driving, and I drive down a one-way street by accident, and I have an accident. And the accident is clearly my fault because I'm not supposed to be where I am. Mm-hmm. All right? And I hurt somebody. And now I get sued. And my $1 million sitting in my beautiful non-qualified account is now subject to the claims of my creditors because I didn't have the right protection around my wealth. I'm trying to get you to think about the variables that are coming beyond the 7 that I just did here. So the most important part, I'm going to say it again because I didn't complete it because I went off on a tangent, which is fun, okay, is that what's your plan? What are your threats? What are your future potential dangers? How is your family going to play into that positively and or negatively? And now just put all these stresses on your plan, and how does the plan perform? Do you like it or do you not like it? If you don't like it, what strategies can you do that are going to reduce taxes, reduce risk, reduce the impact of fees and costs, increase your retirement, have more benefits and more protection, and pass more to your family? If the strategy doesn't do those things, you probably shouldn't be doing it.
Right.
Okay? And then the most important part of any financial plan is to have really good one-year plans. What happened over the last 12 months? What's coming? What's changed? What's different? What's new? And approach the plan as if you didn't build that plan. You're coming in and you're looking at it for the first time, right? Don't have an emotional attachment to it. Because what happens is people come in and they get stuck in what they used to do. Mm-hmm. And the reality is I did that way back when in my financial plan, or I was spending this money on, and this is kind of crazy, right? You start thinking about it in New Jersey. Mm-hmm. We have all these unfunded tax liabilities, pension liabilities and other things. And our real estate taxes are going through the roof. And if you have a house that has real estate taxes of $20,000 a year and you live in New Jersey, how much money do you need in a fund just to pay your real estate taxes? And now they're limited on your tax return to $10,000. The state and local SALT, right? We spent a lot of time on SALT, are now limited to a $10,000 deduction. So you're not even really getting the deduction. If you're making 2% of your money, you need $1 million just to pay your real estate taxes without hitting principal. If you're making 2% net after tax, 4% pre-tax, you need $1 million. So my point here is that understand the financial pressure. The whole thing that I've been focusing on, the reason why I wanted to do the podcast, we've been talking about this for my entire career. Financial pressure is real. Your financial pressure is unique to you and where you are in your life. And how are you going to navigate through it? And if you're sitting here and you're 55, you're 50, you're 60, you're 65, you're going to retire, you just retired, you've been retired for 5 years. Now, right now, not tomorrow, right now is the time to reevaluate the assumptions in your plan. Am I really looking at my financial plan the right way? Should I make some changes now that are going to help me increase the probable outcome of this thing lasting for a long time frame? And there's no guarantee, just because your parents live to 95 doesn't mean that you're going to live to 95.
Very true. Yeah.
Right? Just because your dad died at 50 doesn't mean you're going to die at 50. So you have to look at it as if you're going to go forever. And if you don't, then I don't have the longevity risk.
That's right. That's only one of those 7 pressures, right?
I eliminated one risk.
Right. Well, hey, just to kind of wrap up today too, can you go back over the 7 risks, the 7 pressures that we've talked about, and then we'll wrap up today.
All right, good. So we have to start with the withdrawal rate. Okay. You really need to understand what withdrawal rate means and how that's going to work in your plan. We're going to have longevity risk, and longevity risk, basically under the longevity risk comes, inflation risk and all those things, because that's really what the risk is. The longer that lasts, the longer that you're here, it creates all these other issues. Your pension, your pension risk, if you have a pension, okay, what is the risk on that pension? How much is it funded? How much is it underfunded? And what are your options? 2, Social Security. What part of your projected income, so that's 1, 2, 3. Now we got 4, which is Social Security. What percentage of your retirement income in that, let's assume that $10,000 that we were talking about, how much of that is being covered by Social Security? And you need to remove it and say, if I have too many assets, is it going to be here? Is it going to be means tested? Is it going to be reduced? Is there going to be inflation? But you have to really understand we're at a point where if we're at a 2-to-1 funding, it can't continue.
Yes.
The same way. It can't. I mean, it could, but is it probable?
Right.
Right. Number 5, healthcare costs. Number 6, long-term care. Number 7, market volatility. And let's add an 8th one in just to mess everything up. Premature death in retirement, because we kind of talked about that. And I kind of added that in as we were going.
Yeah.
Dying 2 to 3 years into retirement, it's going to affect Social Security, it's going to affect pension, it's going to affect everything.
Everything.
You need to understand the value of life insurance in your retirement plan and what role it could play to help buffer these things that are going to happen. Really, really important. I'm glad. What I'm really happy is that we can sit here and talk about this. And if you're still listening, you're engaged, right? Yes. And this is affecting everybody in their plan. This is not isolated to people in New Jersey or California or Florida or Maine. It's across the entire country, and it's really around the world. We're all in the same boat. And we better make sure we have enough lifeboats.
That was a darn good ending to this podcast there, John. And you know what? I think that if people have listened all the way to this point, yes, they are incredibly engaged. And I'm hoping that they're also stopping and thinking about what their relationship and what are the questions and what solutions have they gotten from their current financial services professional. And if John has planted even a minor seed of doubt with any of these now 8 pressures, you should probably get a second opinion. You should probably sit down and talk to somebody else who is asking the right questions. Now, John, you have some stuff on your website, right, that people can download pertaining to this. Is that correct?
Correct. There's a series. There's this podcast. There's a series of shorter videos that we do to kind of to dig in a little deeper to some of these actual concepts. We have webinars that go on from time to time, but probably the best tool that we have is the wealth curve pressure identifier.
Yes.
It's a tool that it's a 1-page form that you download and you can print it out, or it's a PDF fillable form. And the idea is it's an exercise to kind of figure out what's going on with my family. What are my income sources? What are my taxes? Where am I saving money? What are my debt structure like? What's my lifestyle like? Where are my assets allocated to, real estate, et cetera, stock options, company stock, et cetera. What are the goals I have set forth, as far as paying for college and, and future liabilities that I need to be aware of? And then how's the wealth protected? And this is not meant to be exact. This is a conversation that I have with all my clients and potential clients, which is, let's have a 30-minute conversation framed around that wealth curve pressure identifier conversation. Let's identify what you love about your plan. Let's identify what keeps you up at night or what you'd want to change about it. And let's identify the 4 or 5 most important 90-day actions to help reducing that risk. Now, you can download the form. We have a video that talks about how to use it. It's me presenting for about 15, 20 minutes on each aspect. And there's no obligation. I mean, you download it, you watch it, you opt out, you opt out. You want to set up a call, you can go right to our website and set up a 30-minute call. And I have, Ed, myself, and a few other people that, we can get you to have this conversation. And there's no obligation. There's no cost. You have the conversation with us. You don't even have to come to the office. Matter of fact, if you want to, great. But get on the phone. We all have 30 minutes on the phone, or less. And if you like the conversation, now let's talk about moving forward. If you don't like the conversation, if it's not the best conversation you've had about your wealth, then I failed, which I'm okay with. Yeah. But it won't be. I can say that most people really enjoy the conversation, and now they want to know more.
That's right. I know I have.
And if I bore you, then okay, sorry.
Yeah. But I think that people who are listening to the podcast who haven't decided to do business with you and your firm, I think we're starting to really peel back the onion to the real juicy parts in the middle that people really need to pay attention to. If you do want to set some time and schedule an appointment, you can do it from the website, which is smallwoodassociates.com, or you can call 800-797-1000. That's 800-797-1000. So, John, thank you for this 2-part series on retirement.
Thank you. Have a wonderful day.
Thanks. And if you have not subscribed to the podcast yet, make sure you click that subscribe now button below. For John Smallwood and everybody at Smallwood Wealth Management, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.